What if one smart decision today could pay you for the rest of your life? In this video, we break down how to build assets that pay you forever into a simple, battle-tested blueprint, the exact asset types, the math behind passive cash flow, and a step-by-step template you can start using this week. Stay to the end. I'll give you one concrete asset build play with numbers that turns a tiny monthly habit into a lifetime income stream. Chapter 1. The Asset Mindset. Thinking like a perpetual earner. What if the difference between chasing paychecks and waking up to income was nothing more than a change in how you see value? The first chapter rewires your mental model. An asset is any resource that produces income or economic benefit without requiring you to trade time for money every single minute. The shift is not mystical, it is practical. It starts with separating consumption from investment and reframing time as a scarce input to be leveraged. Begin by cataloging everything you currently spend time on and then ask a single question for each item. Could this become an asset, a system, or a lever? Your answers will surprise you. A hobby that attracts a small audience could be packaged into a course. A side freelance skill could be systematized into repeatable templates sold as a service. Your local network could be converted into a marketplace for introductions that earn referral fees. The real power comes when you design 3 layers simultaneously. The income layer, what pays you, the scale layer, how it grows without you, and the protection layer, how it survives mistakes and market cycles. Use simple math to test ideas. If you could automate a process to serve 10 clients instead of 1, what happens to your time and margin? The chapter also dissolves common myths. You don't need a fortune to start, you don't need perfect timing, and you don't need radical genius. You need repetition, small experiments, and the humility to learn fast. Finally, adopt a 5-year lens. Assets compound, they rarely flip overnight. Make one micro-commitment today. Document one repeatable process in your work that could be handed off, and treat that single documentation habit as the seed of a future income stream. The asset mindset turns everyday activities into prototypes for cash flow systems and makes financial freedom less about luck and more about design. Chapter 2. Cash flow. First, why income beats appreciation in perpetual wealth. Most people chase rising prices and hope for appreciation. This chapter flips that instinct. Cash flow is the oxygen of durable assets. Appreciation can evaporate. Cash flow feeds decisions, funds reinvestment, and cushions downturns. Think like a landlord or a dividend investor. You want regular receipts that arrive regardless of the headline price. The chapter teaches a practical rule of thumb. Prioritize assets that pay you something predictable, then layer growth. Examples: rental properties that yield monthly rents, dividend-paying equities that distribute earnings, and royalties that drip passive revenue per use. Apply a stress test. If market prices halved tomorrow, would your life be sustainable because income continued? If yes, you've built real resilience. Cash flow strategies also allow purposeful compounding. You reinvest distributions to buy more producing assets rather than speculating on one big exit. The chapter gives a simple allocation framework for early builders. Keep a liquidity cushion equal to 3 months of expenses. Allocate a portion of savings to cash flow experiments, a small rental, a micro business, a dividend portfolio, and reserve a portion for high return reinvestment. It also covers basic metrics, yield, payout ratio, and coverage, so you can evaluate opportunities without jargon. Most importantly, cash flow first thinking changes behavior. You stop timing markets and start engineering systems that generate options and choice. The practical exercise: identify one source of predictable income you can start within 90 days and document the steps and costs. That single action puts you on the compound path from survival to enduring earning. Chapter 3. Real estate: from single units to income ecosystems. Real estate is the archetypal perpetual asset, but not in the way fairy tales describe. This chapter breaks rental real estate into operational parts you can build or outsource. First, pick the model that fits your capacity. Single-family rentals for stability and ease of management, small multifamily for higher yield and scale, or short-term rentals for arbitrage of time and location. Understand the true math beyond purchase price: vacancy rates, maintenance, insurance, management fees, and effective yield after costs. McCoy-style diligence means modeling 3 scenarios: optimistic, baseline, and downside, and ensuring your baseline covers expenses plus a margin. Systems are crucial. Create repeatable onboarding for tenants, a vetted list of contractors, and a simple ledger for cash flows. Leverage powers real estate. Mortgages increase returns when rent covers debt and costs, but leverage also magnifies risk, so guard with conservative debt service coverage ratios. The chapter explains exit strategies: hold for income, refinance to extract equity while keeping cash flow, or bundle properties into small portfolios for sale to investors. It also introduces passive ownership alternatives, syndications and REITs when you prefer capital exposure without the landlord role. Finally, it frames property as a small business. Optimize operations to improve net yield instead of speculating on local price moves. The practical move: run an earnings per door analysis for 3 candidate properties and choose the one with the best risk-adjusted yield to test your landlord systems in the next 6 months. Chapter 4. Businesses that pay you forever. Building systems, not jobs. Owning a business is not the same as being self-employed. This chapter teaches how to design companies that generate recurring profit while you step back. The core is systemization, documented processes, repeatable customer acquisition funnels, and delegated operations. Start by converting your current offerings into products and services with defined scope, pricing, and delivery templates. Use subscription models when possible, retainers, membership sites, or SaaS like recurring services, because predictability scales valuation and reduces churn risk. The chapter provides a blueprint for transitioning a service into a productized offering. Standardize scope, create a delivery playbook, hire or contractor execution, and build a simple dashboard for key metrics: MRR, monthly recurring revenue, churn rate, customer acquisition cost, and gross margin. Multiplying revenue with systems is cheaper and faster than chasing new high-touch deals. Also, learn the art of leverage. Embed intellectual property, templates, or automation that replicate human expertise at lower marginal cost. For founders aiming at passive income, consider licensing models, franchising, or building a management team to run day-to-day operations while you own equity. The chapter stresses governance, board-like check-ins, monthly dashboards, and hiring for autonomy. Chapter 5. Intellectual property and royalties. Monetize ideas. Once, earn forever ideas compound beautifully when packaged correctly. This chapter explains how books, courses, patents, music, and software can create indefinite revenue if you capture ownership and distribution. The playbook is simple. Create a valuable piece of IP, protect or document rights, and design ongoing distribution channels. For writers and creators, rebundle content into multiple formats, audio, short-form videos, gated courses, and place them on platforms that handle payments and delivery. For inventors, weigh the cost-benefit of patent protection versus speed to market and licensing deals. The chapter provides a rule set for pricing royalties and negotiating licenses. Keep a modest upfront fee when you need cash, or prefer higher percentage royalties for long-term income. Always insist on transparent reporting and audit rights. Passive IP income requires marketing funnels that keep content discoverable, SEO, paid ads, and partnerships. Chapter 6. Financial assets. Dividend stocks, bonds, and perpetual income vehicles. Financial instruments are a foundational pillar for perpetual income. This chapter demystifies dividend investing, bond ladders, and income funds with a focus on predictable cash returns. Understand that yield is only useful when supported by quality. High dividend yield can signal risk if the payout is unsustainable. Learn to evaluate companies for dividend sustainability using payout ratios, free cash flow coverage, and balance sheet strength. For bond strategies, build a ladder to smooth interest rate risk and create regular coupon income aligned to your cash needs. Explore municipal bonds for tax-advantaged yield, but check liquidity. The chapter also explains total return versus income orientation. If you need cash, today pick income-focused instruments. If you can wait, combine income with growth holdings. Chapter 7. Content and community. Turning attention into recurring revenue audience is an asset when monetized ethically. This chapter shows how creators turn attention into membership fees, sponsorships, and product launches that recur. The funnel is straightforward: audience acquisition, value compounding, and monetization pathways. Start by choosing a niche where you can deliver unique, repeatable value. Deliver content consistently and collect emails or members. Own the distribution channel rather than depending solely on third-party algorithms. Membership models, monthly cohorts, premium newsletters, or paid communities convert occasional viewers into predictable subscribers. Chapter 8. Private equity and syndication. Scaling. Without day-to-day work. If you want scale without constant hands-on management, private investments can be a vector. This chapter explains syndications, angel investments, and pooled funds where you contribute capital and expert operators run assets. Understand the trade-offs. Higher returns often come with lower liquidity and higher due diligence demands. Focus on operator quality, track record, aligned incentives, and transparent reporting. Learn term sheet basics, priority returns, promoted interests, and waterfall structures so you can model your expected cash flow and capital return timeline. Use syndications for real estate or private businesses to access institutional deals with smaller capital. For angel investing, deploy small checks across many opportunities and expect most to fail, while a few drive outsized returns. The chapter emphasizes governance, require quarterly reporting, access to financials, and clear exit timelines. Practical step. Join one vetted syndication as a passive investor or angel group, commit a modest allocation, and treat it as a learning position to understand private asset cash flows. Chapter 9. Taxes, structure, and legal design for perpetual income. Income that lasts is also optimized. This chapter covers entity choice, tax-efficient ownership, and legal protections that preserve cash flow. Entity selection, LLC, corporation, trust, affects liability, tax treatment, and transferability. Use entities to separate asset risk from personal balance sheets and to enable tax-advantaged distributions. Learn simple tax strategies, harvest losses to offset gains, use retirement accounts for tax-deferred compounding, and optimize holding periods for preferential rates. For international readers, understand local withholding and treaty impacts on cross-border royalties and dividends. The chapter also stresses estate and succession planning. Perpetual assets only remain perpetual if transferred cleanly. Draft buy-sell agreements, create operating manuals, and define transfer rules so assets don't collapse during life changes. Practical task: have 1-hour consultation with a qualified advisor to map an entity structure for your primary income-producing asset and implement the top 2 recommended protections within 3 months. Chapter 10. Risk Management and Resilience: How Perpetual Income Survives. Shocks. Perpetual income requires resilience design. This chapter teaches how to survive downturns while preserving growth. Use diversification not just across instruments but across return drivers, rents, royalties, dividends, and business profits. Build liquidity buffers sufficient to ride 2 stress cycles without forced sales. Stress test assets with scenario planning, model revenue declines, increased costs, and liquidity squeezes, and design automatic response triggers. Cut discretionary spending at X, draw from buffer Y, or renegotiate terms if revenue drops Z%. Insurance is part of resilience. Income protection, property coverage, and business interruption policies reduce tail risk. Also design operational resilience, cross-trained teams, documented processes, and contingency vendors. Finally, practice periodic resilience drills, a quarterly review of worst-case scenarios with a concrete playbook for each, so responses are automated rather than improvised. The practical final exercise: create a 3-tier emergency plan for your top 2 income streams, detailing immediate actions, cash needs, and communication steps so your perpetual income can survive the unexpected and keep paying you forever. Chapter 11. Strategic Partnerships, Leverage. Other people's assets to scale faster. Strategic partnerships are the turbocharger for asset builders. They allow you to access audiences, capabilities, and capital that would take years to accrue alone. This chapter reframes partnerships as structured experiments with clear return paths rather than fuzzy collaborations. Start by identifying the gap in your asset engine. Is it distribution, credibility, operations, or capital? Then map partners who own the missing capability and ask one practical question: what minimal reversible test could we run to see if combining assets creates recurring cash flow? Good partnerships begin with small pilots, a co-branded offer, a revenue share course, or a white-labeled product distributed through an established funnel. Use simple commercial terms for pilots, short duration, clear metrics, and defined exit clauses so both sides can opt out without reputational cost if the test fails. Alignment matters more than charm. Before signing any agreement, list 3 things that must be true for the partnership to work: aligned customer value, complementary economics, and compatible brand risk tolerance. If even one is weak, renegotiate structure. For example, if the partner brings audience but lacks product expertise, structure the deal as a revenue share with a small upfront guarantee to offset their distribution risk and your production cost. Governance is crucial. Establish a one-page operating appendix that defines roles, reporting cadence, decision authority, and basic dispute resolution. This prevents relationship entropy. Culture fit is not optional. Test it in the pilot's first week with shared rituals, a kick-off call, joint dashboard, and 2-week retrospective. Measure hard outcomes, conversion rate, customer satisfaction, churn, and soft outcomes, ease of coordination, speed of decision-making. If pilots succeed, scale systematically, replicate the offer across adjacent audiences, or productize the joint capability. If pilots fail, analyze why: product mismatch, poor offer framing, or misaligned incentive, and keep the relationship warm for future opportunities. Consider capital partnerships for scale, syndication, joint ventures, or passive minority investments where your operational asset plugs into partner capital. In these structures, prioritize contract clarity around distributions, liquidity options, and governance votes. Finally, protect reputation. Include customer protection clauses and joint quality standards. Strategic partnerships accelerate asset creation because they let you focus on your comparative advantage while borrowing someone else's engine. Run partnership experiments like a scientist, small, measurable, and designed to reveal whether a repeatable cash payoff model exists. When you get the model right, partnerships can turn a single asset into a portfolio quickly and sustainably. Chapter 12: Automation and Systems. Turn manual work into passive revenue. Loops automation is where time-levered assets separate from meth-based hustle. This chapter is about diagnosing manual work and converting it into systems that run with minimal human intervention. Start with a process inventory. List all repeatable activities that currently consume your time: customer onboarding, billing, content publishing, support triage, and categorize each by frequency, complexity, and margin impact. Prioritize automating the high-frequency, low-complexity actions first because they yield the fastest ROI. Use the 3-step automation play: standardize, document, automate. Standardization removes variation. Documentation captures the exact decision rules. Automation executes the rule via software or delegated human workflows. For example, transform onboarding into a templated sequence: welcome email, short orientation video, checklist, and automated billing. Over time, supplement automation with decision rules. If the customer does X, send resource Y. If they miss step Z, trigger a human follow-up. Choose tools that reduce cognitive overhead: email automations, simple CRMs, payment processors, and ticketing systems, rather than complex platforms that create lock-in and require expensive maintenance. Chapter 13: Scaling teams without sucking time. Hiring, culture, and delegation for asset owners. A perpetual asset needs a team that can operate when you step away. This chapter reframes hiring not as filling positions, but as building capability modules, autonomous units that own outcomes. Start by identifying the smallest outcome you can outsource: customer support, first replies, content editing, or data entry. Hire for competency and ownership, then create a one-page role contract that lists the single most important metric the hire must improve and the authority they have to act. Use time-bound trials with clear acceptance criteria rather than vague probation periods. Culture is code. It's the shorthand that lets teams coordinate without endless direction. Define 3 core cultural behaviors: respect for metrics, bias to action, and relentless documentation, and weave them into onboarding rituals and team reviews. Delegation requires crisp boundaries. Use the RACI model, responsible, accountable, consulted, informed, at a micro level for each project, so decisions don't deadlock. Chapter 14. International Expansion. Globalizing your income. Streams with local sensitivity, expanding assets internationally, multiplies market size but raises regulatory, cultural, and operational complexity. This chapter gives a practical framework for crossing borders: validate, localize, and protect. Validation means testing demand with low-cost pilots, localized landing pages, translated ads, and small advertising spends in target markets. Use measured KPIs, conversion rate, customer acquisition cost, and early churn to decide whether to scale. Localization isn't just language, it's product-market fit adjustments, pricing sensitivity, payment preferences, compliance, and cultural messaging. Start with minimal viable localization, local currency pricing, key language translations, and customer support during local hours. Learn local payment rails early. Some regions favor mobile wallets over credit cards, and that difference kills conversion. Chapter 15. Exit strategies and liquidity. Selling, spinning off, and reinvesting. Wisely, perpetual income doesn't mean you never sell. It means you design options. This chapter outlines liquidity pathways and exit architectures that preserve value while enabling new investment. Selling an asset, business, property portfolio, or royalty stream requires demonstrating stable cash flows, clean records, and credible growth paths. Prepare early, maintain tidy financials, consistent reporting, documented processes, and customer contracts that transfer. Consider partial exits to monetize while retaining upside. Sell a minority stake to a strategic partner, or arrange an earn-out that pays over time based on performance. Auctions and brokered sales work for standardized assets. Bespoke assets often benefit from targeted approaches, finding strategic acquirers who value synergies and pay premiums. For spinning off, separate the unit operationally before sale, segregate accounting, IP, and teams so buyers can confidently operate post-acquisition. Reinvest proceeds with intent, preserve a cash buffer, allocate to new cash flow experiments, and set aside a learning fund to try a new asset class. Tax planning is integral. Structure sales to optimize capital gains treatment or use tax-efficient vehicles like 1031 exchanges, rollover relief, or retirement accounts where permitted. Liquidity can also come from refinancing. Extract equity via conservative leverage while keeping the income stream operating. Evaluate refinancing costs against progressive use of capital. Are you buying higher-yielding assets or paying down debt with proceeds? Finally, design coachable exits into your asset lifecycle. Set target metrics at which you will consider sale, e.g., X years of stable yields at Y, multiple, and create a timeline for preparing the asset for market. Exit planning turns perpetual assets into flexible capital engines that fund diversification and new opportunities without sacrificing long-term financial health. Chapter 16. Advanced Tax Strategies and Estate Planning. Keep more of what you build. Taxes and succession planning can silently erode perpetual income unless designs anticipate them. This chapter is practical. Consult advisors early and implement structures that fit your jurisdiction and risk profile. Use holding companies, trusts, and retirement vehicles strategically to defer or reduce tax burdens while creating clear transfer paths for heirs. For real estate, 1,031 like exchanges, where available, allow property owners to swap assets without realizing immediate gains, plan holding periods, and improvement schedules to qualify. For business owners, consider family limited partnerships or grantor-retained annuity trusts to transfer wealth tax efficiently while maintaining control. International assets require careful treaty analysis to avoid double taxation. Use local corporate structures, tax credits, and withholding optimization to preserve yield. Charitable giving can be a tax-efficient legacy tool. Donor-advised funds or charitable remainder trusts provide income while unlocking deductions. Insurance is also a tax tool. Life insurance with proper ownership structures can provide liquidity to cover estate taxes without forcing asset sales. Documentation is essential. Maintain valuations, appraisals, and audited financials to defeat aggressive challenges. Revisit plans periodically. Tax laws change, and so should your structures. Finally, simplify for heirs with a legacy playbook, one-page operational manuals, digital vaults for access credentials, and a trusted executor who knows the systems. Preserving assets across generations turns temporary wealth into ongoing capacity for future opportunity. Chapter 17. Behavioral Finance. Designing your life to avoid common money. Pitfalls. Building perpetual income is as much behavioral design as it is math. This chapter explores common mental mistakes that sabotage asset growth: loss aversion, overtrading, recency bias, and social comparison, and gives rules to mitigate them. Create a simple decision framework with pre-commitments, allocation rules, rebalancing schedules, and drawdown limits that you cannot change without a cooling-off period. Use automated contributions to force savings and reinvestment, and automate rebalancing to avoid emotional shifts when markets swing. Implement accountability rituals, quarterly reviews with a trusted advisor or partner who can challenge impulsive moves. Set loss acceptance experiments, small bets where you deliberately test your emotional response to downside so you learn tolerance before stakes grow. Social signaling affects spending. Design a consumption plan that fits long-run goals rather than social cues. Use a 30-day rule for major purchases and a clear purpose statement for discretionary spending. Track vanity metrics versus meaningful metrics. Income coverage ratios and free cash flow matter more than headline net worth. Finally, build psychological buffers, a lean emergency fund for stability, and a joy fund for discretionary life pleasures so financial discipline doesn't become joyless. By structuring your behavior, you create an internal ecosystem that protects the assets you build and lets compounding work without being disrupted by predictable emotional impulses. Chapter 18. Technology and AI using modern tools to amplify asset productivity. Technology multiplies reach and efficiency when used thoughtfully. This chapter covers practical tech plays, automation platforms, AI, content assistance, predictive analytics, and low-code tools that let small teams punch above their weight. Start with tooling that matches outcomes: CRMS for recurring billing, content management for consistent publishing, analytics for conversion optimization, and billing automation for clubs and memberships. AI can help scale content production, customer interactions via chatbots, and personalized recommendations for monetization funnels. Use it to reduce marginal cost while maintaining quality control through human review. Invest in data hygiene, structured customer records, clean analytics tagging, and standardized metrics, so machine learning models produce actionable insights. Low-code platforms let you stitch processes together without big engineering costs. Security matters, protect payment data, user credentials and IP with standard practices, encrypted storage, multi-factor authentication, and routine audits. For creators, use AI to generate first drafts of content to be polished, thereby accelerating volume without losing voice. For investors, use tools to monitor macro signals and automate alerts for rebalancing thresholds. Technology is not a silver bullet. Pair it with strong process documentation and governance to avoid tech debt. Test new tools in small pilots. Measure impact on time saved and revenue added, and scale winners. When technology is aligned with process, it converts one-person efforts into perennial, scalable income engines. Chapter 19: Impact Investing and Philanthropy. Aligning perpetual income with purpose assets that pay forever are powerful instruments for impact. This chapter explores how to channel perpetual income into work that creates social or environmental good while sustaining returns. Impact investing blends financial goals with measurable outcomes. Invest in companies or funds that deliver both positive externalities and financial returns. Use blended finance structures, philanthropic capital as first loss to unlock private finance to fund high-impact projects with sustainable revenue models. For donors, consider evergreen philanthropy, endowments that fund causes in perpetuity through investment income rather than one-time gifts. Establish clear impact KPIs and reporting frameworks to ensure dollars create intended change. Consider program-related investments or mission-aligned venture funds if you seek both impact and capital preservation or modest returns. Ensure governance separation for philanthropic assets to prevent mission drift. An independent board or advisory committee can keep charitable goals focused. Impact can enhance reputation and unlock partnerships, creating a virtuous loop where sustainable giving amplifies both social good and asset value. The practical move: allocate a small % of perpetual income to an impact experiment, seed a local social enterprise, or buy a small stake in a mission-driven company, and measure both financial and impact returns over 3 years. Chapter 20: The Founder's Mindset, Habits, Discipline, and the Long Game of Perpetual Income. The final chapter is about the interior game: habits, discipline, and the patience required to let assets compound. Perpetual income is the reward for daily practices, consistent reinvestment, documentation, learning from small failures, and a bias to long-term thinking. Build weekly routines that protect growth, a cash flow review, a pipeline check of asset experiments, and a short learning session to keep skills sharp. Embrace iterative humility, treat plans as experiments, and be ready to pivot when data asks you to. Maintain physical and mental resilience. Sustainable wealth requires energy as much as intellect. Surround yourself with a small advisory circle, peers and mentors who challenge assumptions and offer accountability. Finally, define the purpose of perpetual income for you: freedom, legacy, or impact, and let that purpose guide trade-offs when opportunities compete. Conclusion: a practical 90-day blueprint to begin building assets that pay you forever. Start small and act deliberately. Day 1. Pick one income stream from chapters covered: rental unit, productized service, digital course, or dividend bucket, and map its 3 core metrics: upfront cost, expected monthly cash flow, and key operational steps. Week 1. Run a validation pilot, landing page, small ad, or outreach to prospective tenants.